Good afternoon from Los Angeles and happy Friday. It's Alyssa Corum and Ken Shreve here with a look at the stock market today. And on today's show, we're going to be talking about Disney as well as Netflix and CSX. But first, let's talk about how the major indexes did today. We have the Dow, no surprise with Disney's gain, leading the gains, up 1%, while the S&P 500 finished up 0.7% and the NASDAQ finished up about 0.5%. So strength in the blue chips today, not only Disney, but others as well.
Yeah, I mean, it's not often we take a look at the Dow chart when we're talking about the major stock indexes, but it was an area of outperformance. A lot of big percentage gainers in the Dow Jones today. Last check, Disney was up 11%, but strong earnings from JP Morgan. Dow, the stock itself, was another nice gainer, so blue chips definitely in the driver's seat. We had modest gains for the NASDAQ and S&P 500. Small caps lagged a little bit, but a good way to end the week.
And more earnings from financials next week.
Yeah, Monday we've got Citigroup and Goldman Sachs. We've got Bank of America after that. So I think there was some hope that the JP Morgan results today hopefully would be good and give the market a nice lift, and that happened. And of course, Disney, which we're going to talk about, was the star of the day.
That's right. Let's go ahead and talk about Disney, with that stock gaining almost 12% today in heavy volume, shooting up to new all-time highs. If you look at a longer-term chart here, that 120 level had been kind of a ceiling here, but a very strong gain today after its Investor Day. More details about the Disney Plus service launching in November, priced at $6.99 with lots of content. So pretty exciting, even though estimates had been looking pretty weak when you're looking at upcoming earnings and sales expectations.
Yeah, so this was, just a really powerful breakout for Disney today. Just a very bullish gap up out of a lengthy consolidation. You mentioned that 120 price level. Looks like Disney closed just over 130. So it sounds very counterintuitive, but with a bullish breakout like this, the stock is still, arguably actionable, because the open price of 127.93. It's really not that far away from there. So. You buy a stock when it gaps out of a consolidation, that can be a lucrative opportunity. So I think Disney Plus that they announced yesterday really exceeded what the market and analysts were expecting. Goldman Sachs was just gushing about it, saying that it was just very robust content, and that low price point, $6.99 a month, is kind of undercutting Netflix quite a bit.
Exactly.
And we've got Netflix earnings next week. So
yeah, I for one was actually a little surprised at just how strong this reaction was today. I don't know. I kind of felt like a lot of it was priced in. There were some rumblings about there being a lower price point, the original content that was going to be on there, but clearly a lot of excitement about this, and we'll have to see if this can become a very meaningful part of the business for Disney.
Well, we had great coverage of the Disney Plus at investors.com today, and one of the main takeaways too, I think, that analysts like, was the fact that Disney kind of gave some spending metrics over the next couple of years about what Disney Plus is, where they're going to be spending money, and it really was a lot less than what Netflix is spending for their original content. So that might have been another thing that the analyst likes. So very positive reception and a bullish day for the stock.
And of course, Disney Plus going to compete with Netflix, as we mentioned, undercutting the price here. So Netflix moved down on this news today, almost 5% in above average volume. We have the stock undercutting that 50-day line here after it had been trading in a relatively tight range. Yeah,
this is, listen, they're just competition concerns here. Netflix, I think their base package is something like $12 or $13 a month. It obviously has a very loyal following, I think 130 million some odd subscribers around the world. And so Netflix, we're going to hear from them next week, Tuesday after the close on earnings, and they posted earnings declines in the fourth quarter. Earnings are expected to decline this time around, but the revenue growth is still there and the subscriber growth is still there for Netflix. So wouldn't be surprised to see another really strong quarter. Technically, the stock does look a little vulnerable with the break of support today, so we'll see what the results look like.
That's right. And want to mention quickly that the annual earnings results, the estimates are still strong here, even maybe some lumpiness in between, but analysts still expect 2019 earnings to come in at 51% and then accelerate further in 2020. Who knows if, how big of a part of the Disney relationship that ending with the launch of Disney Plus might impact. We don't know yet.
Yeah, I mean, there's still a really
strong library without that.
Yeah, I mean, there's still a very compelling growth story going on with Netflix. So we can't throw in the towel on Netflix yet. So again, kind of bearish price action for Netflix today. Very heavy volume on the downside, but we'll see what the earnings look like. It's still a breakout candidate. That 379 recent high of 379. That's a breakout point for the stock. So we'll see what results look like Tuesday after the close.
And we also have CSX reporting earnings next week, and ahead of the results, shares finishing Friday up about 1.7%. It's still within the 5% buy range after a breakout above a handle here. And what does the earnings report for a company like CSX mean when we're talking about the outlook for the broader economy?
Well, I took a look at 3 railroad stocks for today's industry themes column, which will appear in IBD Weekly over the weekend. And it's just interesting with a lot of persistent calls about a slowdown for the U.S. economy. You talk to the CEOs of all 3 railroad stocks, and they're all pretty bullish on the economy. When you look at charts of CSX, which we're looking at right here, still showing relative strength, still in range from that 74.49 buy point. You also have Union Pacific and Kansas City Southern, 2 other big railroads set to report next week. These stocks are near highs, threatening breakout. So, judging by the price action of the railroad stocks, the economy looks pretty good because all 3 of these names are expected to produce low double-digit earnings growth for this year and next. So fundamentals still look pretty good among the railroads, and CSX, KSU, UNP, all kind of in breakout territory here.
Yeah, good to know. And speaking of the breakout, one quick note on our pattern recognition here. Sometimes we do look at these handles that sometimes form within these consolidations, and that's the case here for CSX. So that buy point being 74.49. And it's well above that level right now. Pattern recognition picking up that broader consolidation here. But the good thing, though, about some of these handles that form is that's a lower entry point for investors.
Exactly. So I think, CSX is still holding within range from 74.49. And again, Union Pacific, ticker UNP, and also Kansas City Southern, KSU, 2 other railroads that are executing well. And we'll see what earnings look like next week.
All right. Thank you so much for watching, everyone. And we hope you also check out our investing podcast if you haven't already. Our latest episode just dropped yesterday, so make sure you go check that out for some great perspective on the market and stocks to watch, even more stocks to watch. There's lots of great places to find good stocks to watch from IBD, including investors.com, where you can find all the latest stock news and analysis. And you can also find our content across social media, whether that's on Facebook, Instagram, YouTube, or Twitter. Thanks for watching, everyone. We hope you have a great weekend, and we'll see you right back here Monday.